Well, thanks everyone for being here in person and online. The bottom line of our introductions is cool kids do taxes, and that's what I tell people about. And we've been doing this presentation for a number of years at this point. And what's always really fun is participation from the crowd. So I do encourage you guys to ask questions, and as it pertains to each of you guys individually, I know that there might be something very, very specific. So if it is too specific, I'd welcome conversation after this, okay? So with that being said, do it right the first time is the name of the game in the tax world. And what you guys might not know is what you don't know yet. And my goal is to talk to you guys a little bit about what you don't know that you don't know. Because until you experience something in the tax world, hopefully it's not a negative, but until you get asked a question, you might not know all of the different pieces. So with that being said, before we go too far, does anyone have an entity set up in the room already? Anyone? No? Yes?
LLC.
An LLC, so you have more than one owner of that LLC, or is it just one owner of the LLC? Okay, so we have a single member LLC. Anyone else? No? Anyone online? Someone's willing to join online? Okay. One person have an LLC. One owner. One owner. Single member LLC, as opposed to a multi-member LLC, where there's multiple owners. Single member. Single member.
I'm gonna need you to speak to batteries real fast.
Okay, we're gonna need. So who's excited about taxes?
Okay. We can do it.
Am I good now? Okay. All right, so we're going to talk a little bit about the taxation of each of these, and I'm not going to go too far into the weeds, but in the world that you guys live in, when you guys are starting businesses, more often than not, a single member LLC is what you form as. When you get more than one owner of that LLC, you become a multi-member LLC. I'm going to pitch that would take you into this category. We're going to talk about that. The other category that you often see relates to C corporation, the entity of a C corporation. It is rare in the startup world, if you are looking for institutional investment, that you would see an S corporation, because there's a lot of rules that limit the ownership of an S corporation. So I'm not going to spend any time talking about S corporations, but I include this up here because that sometimes does happen. Okay. So with that being said, what are the rules for each of these categories of ownership? And I'm gonna, like I said, spend time on the single member LLC, the multi-member LLC, and the C corporation, because that is what you will see the most common. A single member LLC is an entity where the income and loss flows through to the individual owner's personal tax return. No separate tax return is filed for that single member LLC. So far, so good. The multi-member LLC, when there's more than one owner, is what's called a pass-through entity. And that entity has an income and loss also pass out to its owners, but on a separate tax return, which generates what's called a Schedule K-1. That Schedule K-1 is what each of the individual's owners use to prepare their personal tax returns. Lastly, a C corporation is an entity that is taxed in and of itself. All of the income is taxed at the entity level, and the losses stay at the entity. Okay, so just to give a little bit of frame of mind of what these entities are and what they do, we're going to talk a little bit about why you would form any of these. So I'm going to start asking questions, and I'd love participation if you're willing. But does anyone know why you might choose a C corporation over an LLC in the investor world? Yes.
I feel like I learned in intro accounting class that it protects the owners against some sort of financial model, like someone in suit.
So liability protection is what? What was your name? Thank you. Liability protection is what she just said, and actually all of these entities give liability protection, not just for a C corporation. So that's a good point, but all of them provide it. A C corporation, anyone else? Any other ideas? And there's a couple reasons. Yeah.
Raising money and allocating shares.
Raising money is exactly one of the main reasons why a C corporation will be formed instead of an LLC. Remember what I just told you guys about where the income and loss of these entities gets passed out to the owners? That means that if an investor invests in an LLC, they have to wait for this LLC's tax return to be completed before they can do their tax. So if you have an investor who's investing in 20 or 30 of you guys' startups, be a problem, because they don't want to wait for you guys to get your act together and get your tax return prepared, right? A C corporation, the income and loss stays with the entity, okay? So investors, that's exactly the reason. Allison, what was the second one that was said?
Allocating shares.
Allocating shares. So shares are what ownership is derived from or given in a C corporation, whereas units are an LLC concept. You can allocate shares or units. It doesn't necessarily matter in that respect. But the main piece why you would form a C corporation, we're going to talk about a second reason in a moment, is liability. The taxes are paid with the entity. Okay. Can you switch from an LLC to a C corporation? The answer is yes. Okay. And we see this a lot because more often than not, guys and gals start out as an LLC and then consider converting in the future. Maybe an investor requires it because they will give you the money until you do. Okay. I'm not an attorney, but I will say this: you can legally remain as an LLC, but make an election to be taxed as a C corporation. You might consider doing that. We'll save you a little bit of legal fees, but you do have to pay attention to a lot of your bylaws and corporation documentation still, if you choose to do that. I'll leave that there. The piece that we talked about, future investors, the fact that you guys can convert later, okay? I do want to talk about C corporations and why you might not want to form as a C corporation. So a corporation is taxed twice, whereas a pass-through entity, these LLCs, are taxed once at the partnership level or at the partner level, the individual owner partner. Okay. This is an example of a corporate tax example where you have $100,000 worth of income. You pay 21%, flat 21% on that $100,000 taxable income. So after tax, you're left with $79,000. And then in order to get the money out to its owners, you need to have a dividend. You need to dividend it out to the owners. And the highest, the dividend, or in order to get the money out to the owners, that's taxed at 20%. Okay, so you're left with about 62 cents on the dollar. Okay. Then there's about a 10% tax rate in Pennsylvania. Pennsylvania is actually reducing it over the next couple of years. It's going down, I think, 7.99. I think somewhere around 4 or 5 in the following years. So finish on board with the tax rate issues here. But you're taxed twice, 21 and 15.8. Not chunk change. But your individual tax rate might be a whole lot lower than that 38%. You know what I mean? That's why you often see startups forming as an LLC. So far, so good? You guys having fun yet? No? Okay. All right. I want to show the same example, but with a partnership and just kind of show you what it means. Okay. You have $100,000 worth of income. You have 4 owners, 3 individuals, and 1 not-for-profit. We'll call it CMU because CMUs are not-for-profit and they take a piece of your company sometimes. Yeah. CMU contributed $100,000 to the entity. They're very nice like that. Yeah. Yeah. So far, so good. So my question to you guys, and I love crowd participation, how is the income allocated to those 4 partners? They each own 25% of the entity. You have $100,000 worth of income. How is that income allocated? And it's in the slides. Sorry?
Because thirds, because the product.
Well, the other three owners are just an equal owner as a not-for-profit. So in this fact pattern, three individuals, they each own 25%. The not-for-profit owns 25% as well. So it's actually going to go to all four of them. It's actually going to go to all four of them, unless the agreement says otherwise, the partnership agreement says otherwise. They're all going to get a piece of it. Let's talk about the same fact pattern, except that it's a $100,000 loss. CMU is one of the owners, and they're paying for this loss. How is that loss allocated? Anyone? Blank break? No. Oftentimes, you would think that it would be allocated equally. When I get tax returns that have been prepared by some other people who are not familiar with the startup industry, that is usually what I see. The IRS has rules, it wants rules, but in this case, the rule said that losses are allocated based on those who are paying for the loss, who are economically on the hook. And in this fact pattern, individual 1, 2, and 3, even though they own 25% of the entity, did not pay for that loss. CMU paid for that loss, and therefore they get $100,000 in their tax return. Why does this matter to you guys? Glad you asked. It matters because when you form this entity thinking that you're going to start deducting losses on your personal return to offset, let's say, W-2 income from your spouse, from yourself, you're not allowed to do that because you did not pay for that loss. Okay? Just be aware of that. Questions? Yes, sir. Yes, sir.
We would like pay for a loss. This is saying $100,000 invested and divested in force, the same $100,000. I'm not following why you're paying for a loss.
Well, CMU was, of the four partners, the one that contributed the money into the partnership. So if you have a contribution from CMU, and you spend all $100,000, you have a $100,000 loss because you had no revenue.
Okay. We're considering the same investment that we're talking. Okay.
Yeah, the $100,000 investment for the CMU, if they spent all of that money, they have that $100,000 loss to use. It needs allocated according to the partnership rules. The people who get allocated a loss, even if you got allocated a loss on your return, let's say it's $25,000, tax law says that if you didn't pay for it, you're not allowed to deduct it. So that's when we see it mixed a lot, and I like to show that example to explain the why. Okay? Yes.
So just to be clear, CMU would be able to deduct $100,000 from most of their income statement.
They could if they wanted, but they're not for profit, so they don't care about their loss. Yeah. So ultimately, though, the following year, if there was $100,000 worth of profit, it would all go to CMU to recoup that loss. This gets into the weeds a lot more than we need to go through at this point. But the allocation rules of income and losses for partnerships are complicated. That is the point I want to get across. So ultimately, your goal is to at least have some idea on the rules behind that, and that's why I bring this up. Or engage someone who does know. Do you know what I mean? All right, payroll taxes. I'm gonna turn my mic off. Actually, let me see if there's anything else that I wanted to talk about here before we do that. Yeah, actually, I did have a couple more things before Megan jumps in. We talked about our early stage losses deductible. We've already talked about that. One of these last pieces are 83B election. Does anyone know what an 83B election is? Have they made it? Okay, so an 83B election is something that is only necessary if your ownership in an entity vests. That means you get your ownership over a period of time, not upfront. Sometimes if you have an investor like Innovation Works, which is a common investor, they require you to not get your ownership immediately. Because when they invest the money, they don't want you to just take it and run. You know what I mean? They require you to stick around, so your ownership vests. This 83B election is essentially you telling the IRS that you are electing to pay tax now on the value that has invested. Why would you pay tax now on a value that hasn't vested? Well, 9 times out of 10, there is no value yet. As much as you think there's a $1 trillion idea, there is no value. So on the unvested shares, you would make this 83B election because it does 2 things. Number one, you're not paying any taxes. And it converts all future appreciation from ordinary tax rates to capital gains tax rates. The highest ordinary rate under present law is 37%. The highest capital gain tax rate is 20%. So any appreciation from 0 to, let's say, $1 million is converted to capital gains rates. If you didn't make that 83B election, and let's say somewhere in the middle, those shares vest, and the value is 500,000, just to make my example super easy, you would have to pay tax on that 500,000 at ordinary rates without the cash to pay for it. You got something of value invested without the cash to pay for it. And then any appreciation from that point on is at the capital gains rate. Okay. So moral of the story, if your shares vest, and this is for a partnership where you have units, or a C corporation where you have shares, same difference. If your shares or units vest, do not miss this 83B election. You have 30 days from the date that you get these shares or units to file the election with the IRS. And a signed copy also needs to be attached to your entity's tax return for that year that you got your shares or units. If you have an attorney who works in this field, in the startup world, they will not miss that. They will give you the paperwork. And if you put that paperwork in the pile on the desk that gets thrown in the garbage, you will miss that election. So pay attention to that. It's so incredibly important. Yes.
I have a question on what like a normal vesting period is. Or can you take advantage of this by like extending your vesting period as far as possible?
You could if you wanted to. This is, I tend to see around 3 years, give or take. I've seen 5 years. I've seen an upfront chunk being given immediately, and then the remainder over the next 3 or 5 years, give or take. So I think that keeping people around is the goal for vesting. You want to keep them in place because if they leave, even if they made this election, they don't get to keep those shares. You know what I mean? Good question. What's your name, sir? Thanks, Rob. I think that's all I have. How's everything?
Sure.
Anyone else? Yeah. Do you have anything else to add when it comes to that? No.
No, if you thought that was fun, I'm really gonna blow your mind. Carissa, feel free to chime in. So we're gonna talk about payroll taxes. And if I can leave you with anything today, it's to not do them yourself. We have seen horror stories of people doing them themselves, and it's just not the route you want to take. So as far as payments for services rendered, so owners of an LLC aren't employees. They don't get a W-2, they're not on payroll. They get what's called a guaranteed payment. The difference between a W-2 and your earnings that way or a guaranteed payment is whether or not tax has been withheld on your behalf. So when you are a member of an LLC, you get a guaranteed payment that doesn't have any tax withheld for you, which means you're responsible for withholding your own tax for federal and state and local purposes. I think that's probably one of the biggest differences as far as, you know, you're still getting money. You're still getting a paycheck. It's just gross versus net. a corporation, if you're a member in a corporation, you get a W-2. It's just like you work at Walmart. You might own Walmart stock, but you work there, so you're going to get a W-2. So there's no real difference in a corp. Another topic that we talk about a lot is employees versus independent contractors. And that's something that we see a lot in the startup industry, and a lot of issues with that. So when you're thinking about independent contractors, one of the things you want to think about is control. What are they doing? Where are they doing it? How are they doing it? Are you telling them what to do? If the answer to those things is yes, then 9 times out of 10, they're probably an employee versus an independent contractor. If they are out selling their services to other people and they have a business card and they're doing the same thing they're doing for you for multiple people, it's possible that they are a contractor. But if not, they're probably an employee. We see this with interns a lot. So interns, if you think about it, they don't really know what they're doing. You're teaching them what to do. So without you there to lead the way, like they don't know what they're doing. So they are employees. And sometimes that's problematic because you might have an early stage company that doesn't have payroll set up. And they think, well, we can just pay them as an independent contractor and we don't have to worry about it. But that's not the answer. And a lot of times, there are payroll audits and you can get audited. And if you mess it up, it's very hard to untangle. Yes.
Yeah, absolutely. I will say here, we're going to talk.
Someone started using the frequency we're on, that's
Can we use this mic up here?
yeah.
Okay. The only thing I'd add with that is a lot of what we talk about, there's the technical rules and the practical rules. We often see people still deciding to not put those interns on payroll, but that is technically not correct. Okay. So just be very careful when it comes to that.
Right. So again, I'll say, should we outsource payroll? Yes. Don't do it yourself. Before you start issuing payments to anyone, there's 3 different forms that you're going to want to have, on your file. So an I-9, you might have filled one out yourself. It's for any employee. So you're going to get their information, their social security, address, things like that. For an independent contractor, the form's called a W-9. And in our experience and our advice is to get them to fill that form out when they first start working for you, because if you wait until December at the end of the year and you haven't talked to them for maybe 8 months, you may not be able to ever talk to them again. And you have to report the earnings to them. So it's a lot easier to get it and say, well, we'll give you your payment when you give us this form than it is to try to hunt them down later because you have to file this form. The other form to be aware of is the W-8-BEN, and that's for foreign contractors. So there is a requirement for foreign withholding. If you can't find them, you're on the hook. You have to pay that foreign withholding. We always advise people don't pay anyone before a system is in place, because if you start just, giving people checks, you have to go back and do the withholding once you run it through payroll. And it's not a good idea. Payroll companies don't like that. The only other item on this one, I think, unless Chris has anything to add, is employee withholdings have to be paid timely. If not, your company could be on the hook to pay that. Just like, if you don't take payroll taxes out and they quit or something, if you give them a check before you have payroll and it's gross, and then you say, oh, no, we need to take taxes out. It's too late. If they don't work for you anymore, they're not going to pay you back probably. But anything else? Any questions on? Yes.
Yeah, I have a question on, so a startup, leisure services to help do their payroll. How are you guys getting paid? Or like startups not having like a lot of cash or potentially operating a month like these?
You mean like the third-party provider?
Yeah.
Like how are you paying them as an entity? Or
how much your services? How do you expect a startup to pay you?
Well,
That's a difficult question. I mean,
right.
You get what you pay for. So if you choose to do it yourself, Rob, like if you do choose to do it yourself, you can. But that's another issue of you don't know what you don't know.
Yes.
So, for example, there are not only federal, state, and local withholdings, there are also additional Pittsburgh taxes. The rates are different. Not only are they different, but it could be different if you're in Philadelphia, because there's also Philadelphia. I can keep going on. But my point is you can do it yourself. but I guarantee you it'll cost you less time and money to outsource something like that. Gusto, for example, is one of those online providers that is relatively cheap. It is made by startups for startups. So I see a lot of my startups using those. The alternative is your household brands like your ADPs and Paychecks. Generally, the costs raise and increase as you do have more employees. But it's up to you. There's quarterly withholdings and there's annual filings for each of these categories. We don't do payroll. It's not, we choose not to do payroll because there are people and entities that is their bread and butter. They do it well. They have the systems processes in place. Don't do it yourself. It's a trap.
So your recommendation is as soon as you have an employee. to
Yes.
outsource it.
Absolutely. Without a doubt.
Okay.
I'll say it one more time, without a doubt. I can tell you horror stories. You want to talk after? I'll tell you some horror stories of things and people not doing it right the first time. And it costs you more in the long run.
And a lot of times the payroll providers don't want to fix someone else's mess
They
either. So if you
refuse.
come to them with this garbage file and you're like, help me, they might.
They don't want
no.
the liability. They refuse. And it's very rare if I've never seen an issue or never seen someone go back and file. So
The other thing I'll caution you on is the QuickBooks payroll. It's popular, but it's not great. Like Carissa was saying, there's different local rates. QuickBooks doesn't always know those things. You know, they might just have Pittsburgh at 3% when somebody might have a Pittsburgh address with a 1%. And if you don't catch that, it's not going to catch it because you are the person doing the payroll. It's just facilitating what you're doing. So I would caution against using QuickBooks for payroll as well. I will say, I think QuickBooks does a pretty good job with the 1099 filings though.
they do. Yeah.
So if you need to file those online, just to mention it, because everyone always scratches their head when I say this, 1099s can either be filed online or on carbon copy paper from the IRS, carbon copy paper. So you can do them online or that. You can't just like print them out and do them. So carbon copy paper.
Special ink to be able to read it. So you can go to Staples and get like the versions of the special ink, but it costs less to do it online.
Right. All right, moving along. Sales and use tax. So sales and use tax has been under more scrutiny lately because of the Wayfair versus South Dakota case. I don't know if you're aware of that. Wayfair obviously is a retailer of online goods, right? They're selling to people everywhere. What Wayfair wasn't doing was charging sales tax in all of these states that they were making all of these sales. So their customers were in South Dakota, but they weren't charging sales on those South Dakota products that they were selling to them. So it went to the courts, Wayfair lost and kind of set a precedence for all of the other states to jump on this bandwagon of saying, okay, you know, you're selling in our state, like you have to charge sales tax now. So there's thresholds. I think they're similar. I don't know what the exact numbers are, but it varies by state, but I think they're all around the same thing. So that's something to be aware of before you ever sell a product. You want to make sure that you know what your sales tax requirements are before you actually make that first sale. Because again, if you sell to somebody in Omaha, Nebraska, and you didn't charge them sales tax, you're not going to get it later. You're not going to send them an invoice where, hey, we forgot to charge you this. Please pay us now. It's not going to happen. So that's something to be conscious of as you're starting to make your first sale. I think, you know, tracking system, having that in place. I know, you know, a lot of the online softwares can help you with that. You can kind of put in addresses and it'll kind of do that for you. And then just to mention, software as a service is kind of a hot ticket item too, because depending on where you're at, it can be subject to sales tax as well. So if you think, oh, I'm just selling software as a service, like it's not subject to sales tax, it's not a product, that may not be the case. So again, it's important to talk to somebody. If you don't know, if you can't find the answer, reach out to someone that might and figure that out before you make your first sale. As far as who's required to pay sales tax, there are exemptions. So for example, if you are buying pieces to manufacture your product that you're going to sell to an end user, you can get an exemption for those pieces that are going into your product because you're going to charge sales tax on the final product. And sales tax is kind of like a one and done thing. It's not supposed to be over and over again. There's an exemption form, I think it's REV 1220 that you can fill out. Similarly, if you are selling to someone that's exempt, so for example, like a government or a government organization or something that doesn't pay sales tax, they should be giving you an exemption certificate to say, hey, I don't have to pay sales tax. And you want to keep that for your files. Because if you ever get audited and you didn't charge it and you should have, you want to be able to support that. Again, before you bill your first customer, do your homework, get advice on the rules, avoid surprises. Sales tax audits are not uncommon. Also, if you're in another state, it's possible that you might get like a questionnaire where they're trying to dig and find people that might be subject to sales tax. So that's something to be aware of as well. They could catch you there. Use tax is, so if you buy things from another state and you didn't pay sales tax, it's kind of, you pay it at that point. It's similar to sales tax, I guess, but it's just if you didn't pay sales tax at the point of purchase. Any questions on sales or use tax? I know it's real exciting.
The only thing I would add with that is the general thresholds are 200 transactions per state per year, or $100,000 per state per year for sales into a state. That doesn't necessarily mean your items get subject to sales tax, but rather it's when the filing requirement comes into effect. Sales tax is not something you want to mess with because it is a very huge issue when you guys go through due diligence. When do you go through due diligence? When you're trying to get investor money or when you're going to be acquired. There is an entire section on a due diligence checklist related to sales tax. Okay. It's just one of those things that before you make your first sale, you at least do your homework. That homework is a continuing thing because tax laws change. They change in the states. It would be nice if they were all the same. Wouldn't that be nice? But that's not the case. So due diligence, this is where it makes a difference when you guys go to sell your company. So let's say, for example, you go to sell your company for $100 million. I have seen holdbacks for that $100 million in the tens of thousands because of the sales tax issues associated with it. So be aware. Not always tens of thousands if you've at least done your homework up front, but your goal is to tell that investor or the acquirer, we recognize there may be exposure, but this is why we didn't file. And that gives them a comfort that you've at least done your homework. Okay.
Yes. Sorry.
The thresholds under present law are different in every state, but generally it is no less than 200 transactions per state per year, or $100,000 of revenue for a customer per state per year. And there's charts out there, all kinds of charts. And the reason why it doesn't go below that is there's a fear because of the Wayfair case of it being deemed unconstitutional. That was the threshold that was put in place at that time. And so that's where a lot of states jumped on that bandwagon, to Megan's point. Yeah. Sure.
All right. So as far as accounting, who will keep the records? So we all know when you're starting out, you don't have any money, probably. Hopefully that changes soon. But does it make sense to pay someone? Does it make sense to do it yourself? Is something you're going to have to decide. I think when you're first starting out, sometimes Excel is okay. You can use Excel as long as you have things properly categorized and you know what's going on. But as you move on, your time is much more valuable running the operations of the business than it is to spend time bookkeeping. Because I can tell you bookkeeping sometimes is a lot to do. So that at that point, it's normally a good idea to seek out help. Bookkeepers come in an array of different offerings. You can get transactional ones that just kind of go by transaction. You can have someone come in once a month, close the books, reconcile the bank account, and you're on your way. Business versus personal, something we want to mention here is avoiding charging personal expenses to a company card. I can't tell you how many times I'll be going through somebody's general ledger and I'll see like something and I'm like, what is this? And they'll say, oh, I used my personal card by accident. Okay, well, that's not allowed. So you don't want to do that. So if you just keep them separate to begin with, you don't have to worry about mixing them. And another thing too, investors don't want to see you taking their money and using it for personal things or commingling your funds. As far as software goes, I will say 90% of our clients use QuickBooks Online. It's probably one of the most well-known softwares out there. The thing that's nice about having a software is the ability to print on-demand financials. So if you have somebody come to you and say, I want to invest in your company, can you give me a balance sheet or a P&L for this year or whatever? And you say, yeah, I'll get that together. And it takes you a month to do that. They're probably like, okay, never mind. If you can pull that report within, a week or maybe less time, it's going to look better for you to them. If you have inventory, it's even more important to have a software. It's impossible. I would say impossible to do inventory in Excel. Maybe if you have like 10 pieces of inventory and that's it. But for the most part, the volume you can't keep up with it in Excel, and it's a lot easier to just have it in QuickBooks. And again, be able to pull reports and, see aging reports and things like that. I will say one of the nice things with QuickBooks is as far as document retention, I think you can take a picture now of things and just upload it right to QuickBooks and it'll save it for you. You can link it right to your bank account. We are not a salesperson for QuickBooks. I just really like it. But, the banking feature it kind of recognizes the transactions too. So it'll start to remember what you're doing and kind of say, you just have to say yes. So it kind of cuts down on the time for your bookkeeper. So they charge you less maybe, As far as other document retention, you can be audited for up to 3 years, but we normally recommend keeping things for at least 7. Things like equity documents and loan documents and things like that, you're going to want to keep those forever, as long as the entity exists, at least. Does anybody have any questions on accounting? Chris, do you have anything you want to add?
The only thing I'll add is oftentimes I get the question, will do bank statements count as receipts? And the answer is no, they do not. The IRS will throw that expense out and say no deduction. Be careful. Okay? Credit card statements do not count because you can't tell what the itemized list of the things that you purchased. So you go to Target, you buy a printer. They don't know you bought a printer there. You could have bought shampoo for all they know. It doesn't count and they'll throw it out. Okay. Investors don't like to see that kind of thing either, just so you know. Questions? No?
I have a question online.
Absolutely.
What counts as a receipt on a credit card statement on Uber or Uber?
Uber, I think that there's probably some wiggle room there. And I say this because Uber, you get what you pay for, but the business purpose isn't necessarily there. If the IRS was to come in and audit you, you would have to prove why that's a business expense, which might not be very difficult if you have, let's say, your Outlook calendar, you were in Cincinnati at this time for business. Do you see what I mean? But it's still a good practice, and Uber sends receipts to your email. Like, it's not hard to keep that, but no credit card statements, which I think was one of the questions. Anything else on that front? No? Okay. All right, apparently I'm glued to the podium, so if I move away and you can't hear me anymore, please do let me know, but I like to move around, so I have issues there. Okay, so early stage issues. These are things that don't fit into a nice and tidy category that we've already talked about. If you guys are formed and doing business inside Pennsylvania, let's say even if you're formed in Delaware, Pennsylvania Form 100, PA Form 100 is done online, and it's Pennsylvania's one-stop shop to get your account numbers for payroll, for your revenue ID, which is your PA ID that needs to go on your Pennsylvania tax return. Legal counsel will not do this, but I have a caution. This is also where you'll sign up for your sales tax account number. Do not request a sales tax account number until you have sales, because they will expect you to file zero balance reports until you have your sales. The same concept is for payroll withholding. If you have no employees, until you need that account number, do not register for payroll withholding account numbers. You'll start getting notices from PA, the angry notices saying, why haven't you filed these forms? Okay. It's not difficult to do. It's just one less thing you have to worry about. I would say though, you need to at least give a couple week lag before you have your employee. This is not something you can get instantly. Okay. So give yourself enough time to get that account number, and don't start paying them before you have all your account numbers, which is what is absolutely needed to get started on Gusto, for example. Okay. The IRS sends you your welcome letter when you get your EIN. A lot of people can get it electronically. You also get a letter in the mail. Pennsylvania welcome letters, that's what gives you your EIN or your revenue ID for Pennsylvania, or your withholding account numbers or sales tax account numbers. Keep those because all kinds of people need it. Okay. Convertible debt. Does anyone have any convertible notes in this room right now for their company? No? Maybe online, that's a possibility. But convertible debt is a common way that early stage investors will invest in startups, okay? And it is essentially where it is a liability, it is a loan to the company that will convert at a future agreed upon event. Let's say you have an equity round, or you get acquired, or you reach a fair market valuation where you reach a certain level. That convertible debt will convert from debt to equity at those agreed upon procedures or agreed upon time. Now, what we always see missed, because it's not being paid in cash, is interest must be accrued on that convertible note. Pennsylvania is like this general area, the common rate is around 8%. I've seen it as low as 6% and as high as 10%, but 8 is generally what I see in our market here, okay? You are required, the company is required to issue a 1099, that doesn't work, a 1099 OID for the interest as it accrues annually. Now, if Uncle Joe gives you $100,000 on January 1 with an 8% interest rate, and you have $8,000 of interest, and you say, here's your 1099, report $8,000 worth of interest, and they're not a savvy investor, they're going to be like, whoa, whoa, whoa. I don't have $8,000. I have no cash. I didn't get any money. I shouldn't have to report this interest. The rules say otherwise. I have all kinds of literature if you have an interest, but 1099 OIDs are required annually for interest as it accrues. There are exceptions. The exceptions are including if the interest is paid to a not-for-profit, CMU, Innovation Works. If they're paid to a corporation, they don't care. So just keep that in mind. You don't want to make Uncle Joe angry, right? Because he gave you $100,000. Okay. Request a W-9 from those note holders at the early stage whenever they're signing their convertible note paperwork, because you need their name, address, social security number, or EIN to file these OIDs, 1099 OIDs. Okay. Any questions on convertible debt?
I'll say that W-9 is the same W-9 you're getting filled out for your independent contractors. Same thing, same form.
Yep. Stock options. Stock options are things that I tend to see when an entity is trying to attract talent, right? It costs money legally to set up a stock option plan, so you don't always do it as early as you might. But there are different types of stock options, incentive stock options and non-qualified stock options. The tax consequences to each of those are different. So my recommendation, and I'm not going to go into them right here, but generally at the initial issuance of options and the granting of options, there are no tax consequences. It's only when they're exercised. This is all general, guys. This is general. When they are exercised, that is usually when there are tax consequences. Okay? Just be proactive. This category here, when does business begin? And how are we doing on time, by the way?
2018.
2010? Okay, we have some time. Okay. So when does business begin for tax purposes? And you might say, who cares? I'm going to tell you why it matters. In the early stage life that you guys live, you're spending more money than you're making. You don't have revenue streams that exceed your expenses, right? Because you're doing R&D. You're trying to develop what it is that you're doing. Okay. The IRS says that if you haven't begun business, if you haven't said, hey, world, come buy my product or service, you are not allowed to take a deduction from many and most expenses. That doesn't mean you lose those expenses. There's an exception, which I'll talk about in a moment. That doesn't mean you lose expenses. That just means that they get spread out over 15 years, right? This code section that includes this is an area where we see missed a lot in the startup world, okay? You might think you can take these deductions to offset other sources of income if you're a single member LLC, but until you can say, hey, world, come buy my product, or you have an invoice out there, you cannot take certain deductions. Now, this leads me into this next category down here. Up until 2021, you were allowed to deduct research and development costs. Most of my startups would say, well, that's all I'm doing. So why do I have issues here? Well, legal costs are not R&D. Marketing expenses are not R&D. Rent is not R&D. So there were a lot more things that were not deductible than startups might have realized. But until 2021, you were allowed to take research and development costs as a deduction. That has changed under present law in 2022. And I'm going to get on a soapbox for a few moments and talk about this section 174. And I don't like to use a lot of code section. You'll notice at this point. But the ability to deduct R&D costs in 2022 has ceased under present law. And there is a lot of kerfuffle at the Congress level right now to get this changed. Because the Pfizers of the world, right? The Pfizers of the world, the Apples of the world, that is what they do a lot of times. So not being able to take an immediate deduction, but rather having to spread it out over 5 or 15 years for R&D is a major issue. For those entities that exist that have no revenue, this is not necessarily as big of a problem in the immediate future. For those entities who have grant revenue, this is a huge issue, and I'm going to explain why. If you have a $1 million grant, that's income in the eyes of the IRS. Let's say we spend all $1 million, $1 million worth of income, $1 million worth of expenses. You net zero. But let's say most of that $1 million is spent on R&D, which is usually required by the terms of the grant. You're not allowed to take an immediate write-off of that $1 million. So now you have income to pick up and you're getting whiplash. It's a huge, huge issue for a lot of our startups, okay? Of that $1 million under present law, only $100,000 is deductible. So now you have, in the first year, by the way, now you have $900,000 worth of income to pick up without the cash to pay for it because you spent all $1 million. Huge issue, guys. Okay. If you have questions, feel free to talk to me after this because I don't want to spend too much more time on it, but it's a major issue. It doesn't mean you lose the deduction. It just means it gets spread out. But from a timing situation, this is a very huge problem. There's a lot of pressure to get this overturned and changed. But until it happens, we're kind of just letting our clients know the risk and exposure. We are seeing some motivation to potentially extend their 2022 tax returns because of this, to see if it gets overturned after April 15th. It's up to you on how you go about it. Okay? Tax credits, but before I move on, any questions on this front? Okay. I'm gonna stick with research and development because research and development has tax credits, both federal and state. Okay. There are three categories that qualify for the R&D tax credit. Wages for the proportion of time spending doing R&D. Yeah. You have to pay someone to get that. Independent contractors, if you're outsourcing R&D. Foreign outsourcing overseas does not qualify. And then lastly, supplies that are consumed in the R&D process. Okay, those are things that are made for your prototypes. It includes, you know, chemical A and B or widget A and B that go into those prototypes. Okay, if you're a SaaS company, it is rare that you have supplies. Okay. The federal tax credit is included in the federal income tax return. Okay. And that federal tax credit on average is about 6.5%-ish of the costs that qualify. Okay. In a perfect world, time records are ideal. This is an area, however, that the IRS allows for estimates. But just be aware, don't the pigs get slaughtered. Is that the whole adage there? So just be aware of that piece, okay? The federal R&D tax credit is not allowed to be funded by government grants. Okay, and I see that a lot. So you do not qualify for the credit if the use of government grants is what's funding the credit, because you're really not on the hook for it. Okay. So how do you use these credits, you might ask? Well, I'm glad you asked, because as a startup, you might say, well, I'm not paying any taxes because I'm losing money, right? The federal tax credit a couple years ago, the rules changed such that you were allowed to make an election with your federal tax return to use the federal R&D tax credit to offset payroll tax, the employer portion of the Social Security tax. Okay. And that election must be made with a timely filed return. You can't go back and amend for this, but it's free money. And it's a way to monetize this credit. Otherwise, it would simply carry forward for 20 years until you owed taxes. Okay. Pennsylvania also has a tax credit, but you need 2 years worth of expenses incurred in Pennsylvania in order to qualify for this tax credit. Because the calculation is based on an increase year over year in your R&D expenditures. The best part about the PA tax credit is that it can be sold for cash. And there's a very ready market for these tax credits, and the sales price is anywhere from 80 to 90 cents on the dollar. You're already doing the R&D, guys. You might as well get a tax credit while you're at it. Okay. So again, the federal credit is part of the entity's return. The Pennsylvania application is a separate application that comes out usually in the summer. The application cycle opens in the summer following the due date, like following the year that the expenses were incurred. Okay. And it's due, by the way, on December 1st of the year following. Questions about R&D? No? None from the Peanut Gallery online? None? Okay. All right. The Keystone Innovation Zone tax credit is another credit we see here in Pittsburgh. In Pittsburgh, there are 2 zones, and this credit is based on the geographic location of the company. And those 2 zones are the Pittsburgh Central or the Greater Oakland. Now, the point of this tax credit is a Pennsylvania tax credit, and it's calculated based off of an increase year over year in revenue. So let's say in year 1, you have an invoice for $100. And in year 2, you get an SBIR grant for $210,000, $250,000. Usually it's not just that odd number, right? Grant revenue is allowed to count towards that increase. And oh, by the way, if you're located in this zone, and you're doing work that qualifies for the credit, which I suspect a lot of you guys would be, that max credit would be $100,000 based on that calculation. Okay. This credit can also be sold for cash, 80 to 90 cents on the dollar. Ready market out there for it. But just keep this in mind because there are some due diligence pieces in year 1 and year 2. The planning opportunity is you might consider locating yourself in one of the zones to take advantage of this. Okay. Due date, December 1st, similar to the R&D tax credit in Pennsylvania. So there is a lag in the opportunity to sell these credits. You have to first try to offset it against taxes. And if there are no taxes, then you're allowed to sell it. But you're already doing the work, guys. You might as well get a credit for it. So just keep an eye out for these things. Okay. Any questions about tax credits in general? No? We talk about Pennsylvania tax credits because that's where we are, but there are other credits across the country. There are other incentives out there for locating yourselves inside certain geographic locations. There are job creation tax credits if you're hiring significantly in a certain area. Bottom line is you sometimes have to plan ahead. You have to apply for these credits before you start doing the hiring. So just keep that in mind when you're expanding across the country. Okay. So with that being said, I'm going to leave you guys with this last slide. Economics first, practicality first, taxes second. We talked a lot about the technical rules here, and the technical rules, we understand you're a startup, and so you might not want to do payroll the proper way, but from years of experience, doing it right the first time will save you a lot of money in the long run, but it might cost you more. But doing it right the first time makes a difference, okay? So we want to minimize taxes, get to tax credits and all of those things, but make sure you're doing things right, okay? So with that being said, at the very end, here are our information pieces for you. Feel free to reach out to us if you have any questions. We've been working in this industry for a long time at this point. It's a lot of fun. You're all doing something different, something interesting. But as you guys grow, there's like a whole host of issues, state, sales, income. So it's a lot of fun. But does anyone else have any questions? Anything you're wondering about? Anything online? No? Okay. Well, with that being said, we'll stick around up here for a few moments, but thanks for your time. Thanks for your attention and the questions around the room. We really do appreciate it. Makes taxes a little bit more exciting, and I know it's not always the most exciting thing.